Hello and welcome to the Indian Express. In his first policy review since taking office, RBI Governor Sanjay Malhotra shared some important insights on the country's economic outlook, interest rates and external sector performance. Let's dive right in this video. Governor Malhotra announced a 25 basis points cut in the repo rate, bringing it down to 6.25%. This move is aimed at stimulating economic growth and easing the burden on borrowers amidst global uncertainty. This will also encourage spending and investment. The RBI's decision is a clear signal of its intent to support growth and stabilize inflation as the economy recovers. Now, on the growth front, the RBI has estimated that India's real GDP will grow by approximately 6.7% in the coming year. According to Governor Malhotra, India is positioned for strong growth driven by robust domestic demand and external investments.
All these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%. Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation after moving above the upper tolerance band in October has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect.
Remittances and external sector resilience. A particularly interesting point from the governor's address was the strength of India's external sector. This level of reserves provides an import cover of over 10 months, ensuring stability for the economy moving forward.
According to the World Bank, India, with an estimated inflow of $129.1 billion, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at 630 plus billion US dollars. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatilities.
He also discussed India's current account deficit, emphasizing that it is expected to stay well within sustainable levels this year. He further reiterated the RBI's commitment to maintaining orderly and stable exchange rates, which have been consistent over the years. The RBI's forex interventions aim to smooth out excessive volatility, but they do not target any specific exchange rate levels. The Reserve Bank has projected retail inflation at 4.2% for next financial year, beginning April, while retaining the forecast for 2024-25 at 4.8%. RBI Governor also introduced a new bank.in internet domain for Indian banks and stricter authentication protocols for digital transactions. In a bid to reduce online financial fraud, the RBI will implement this domain exclusively for banks in India starting April 2025. That's it for today. Stay tuned for more updates on how these developments impact the economy. Thanks for watching and don't forget to like and subscribe to our channel, The Indian Express.